Welcome back to the show, my friends. Postcards from Success. I'm your host, Thomas J. Nelson, and I have a returning guest, both from my previous podcast and from Postcards, Rachel Ivanovic, who is my tax preparer. She's an enrolled agent at Easy Life Management up in Carlsbad, California, but guess what? She can serve you wherever you are in the world, so don't let the location of her office limit you using her. If you're somewhere other than San Diego, you can still enjoy her professional services. And as you can tell, I highly recommend her. Rachel, welcome to the show.
Morning, Thomas. How are you?
I'm wonderful. How are you doing?
I'm great.
So the reason I have you back on because, well, obviously taxes are a big deal for us entrepreneurs and small business owners, and there's always changes. We went through one of the biggest tax overhauls last year in about 3 decades?
Since 1986.
Wow. So, but we're really not seeing the effects of those for another couple weeks. It was probably a little confusing for people because it happened last year, but it goes into effect in the new year of this.
For the taxes that we'll be filing in the spring.
Right. Okay.
Right. And
there's a lot of misconceptions on the changes. So we wanted to kind of clear up some of those misconceptions today.
Absolutely.
Okay, so what we're talking about is understanding the Tax Cuts and Jobs Act of 2017. So let's start with, what are the biggest changes to itemized deductions?
All right, well, thanks, Thomas, and thanks for having me. I'm really honored to be here today. I really appreciate you asking me back.
Absolutely, glad to have you back.
Thank you. So, as you were saying, Thomas, yeah, back in December of last year, there was a lot of, the press was really giving the changes a lot of attention. And so there were 2 different bills that were circulating. And so a lot of people don't really know what actually was passed and what wasn't passed. So I think one of the biggest changes was to the deduction for what they're calling SALT, or the state and local taxes. So it will affect taxpayers, in particular in states such as California, New York, New Jersey, where we pay really high state income taxes. Because in the past, you could deduct all of your state and local taxes, your car registration fees, and your property taxes on your primary, secondary residences, actually as many properties as you had. And now that deduction is limited to $10,000. It's capped. And so that is going to be significant for a lot of taxpayers.
Right.
And there have been, some states have been trying to come up with some workarounds. Unfortunately, IRS has shot those down too. So there are some planning techniques that we've come up with that you definitely want to talk with your tax advisor about.
Okay. Now, am I correct, or correct me if I'm wrong, there's no cap on property taxes for business or rental properties, is that correct?
That's correct. So for rental properties, it's business as usual. You still can deduct all of your property taxes and other taxes that you pay. Same with businesses. There were no real changes. Well, there were a few small changes for businesses, but for the most part, you still can write off all of your expenses for your businesses and for your rental properties. So you may be alluding, Thomas, to one of the deductions on itemized deductions that was cut, and this will be a huge impact for employees. So if in the past you've itemized any unreimbursed employee expenses, those now are no longer deductible for federal purposes. You may want to check with your state because, for instance, in California still allows these deductions, and they don't have no cap also in California for property taxes. So if you own multiple properties, let's just say you own a primary and a vacation home, maybe you own a piece of land, for California purposes, you still can continue to deduct all those property taxes.
Okay. What about mortgage interest deductions?
So that is also a huge change going forward. Now, what you also have to keep in mind is that these changes for the Tax Cuts and Jobs Act of 2017, it's scheduled to expire at the end of 2025 unless Congress makes it permanent. So what that basically means is we have this new tax code, these new tax laws for the next few years, and then unless Congress makes it permanent, it will go back and revert to the old tax law in 2026. So for mortgage interest, for rental properties, you're still business as usual. You can write your mortgage interest off, so don't worry about your rentals or businesses. for per primary residence and for secondary residence. In the past, you could write off interest on loans up to $1.1 million. So to get technical and a little tax nerdy on you, it was $1 million acquisition indebtedness and $100,000 home equity debt. Going forward, it's a little bit different. So going forward, pause. So going forward, the new code allows you to deduct up to $750,000 mortgage interest. And they do have the allowance for first and second residence. So you still can have that vacation home. Unfortunately, the new limit is only $750,000. And home equity lines are no longer deductible if you have used the loan proceeds for anything other than to buy, build, or improve your home.
Okay, so to unpack that a little more, whereas in the past you had a home equity line of credit that no matter what you used it on, it was deductible. Now
up to $100,000.
Okay, so now we're only allowed to deduct if we use it for, I mean, arguably what it was intended for, which is to make capital improvements on your own property or a rental property or to buy another property. So in other words, if I use my home equity line of credit to send my son to college or to buy a new car, that's not deductible.
Correct. That's no longer deductible.
Okay.
And even with your original loan, you do need to be careful with how you use those proceeds. So if you do a cash out refi, you really need to be careful, because if you take that money and you use it for something other than to put on a new kitchen in or to remodel or a new roof, then it will no longer be deductible, even if you're under the limits.
Okay, good to know. What about charitable deductions?
There's really been not a lot of changes to charitable donations. As in the past, for most charitable donations, you can deduct up to 50% of your income. For 2018 and through 2025, you can deduct up to 60% of your income. So still time to go out there and make some donations for the end of the year.
Okay. How about medical expenses?
So medical expenses are still deductible as an itemized deduction. However, in the past, it's been that you could deduct anything over and above 7.5% of your adjusted gross income.
Okay.
And now on up to anything over 10%. So
okay.
It's still really hard to write off your medical expenses. So one of the things that we recommend is if your employer has a flexible spending account, make sure that you're taking advantage of it. I think right now in December is a really good time to review those, and you can enroll in them this time of year. Do keep in mind with flexible spending accounts, if you don't use it, the money, you do lose it at the end of the year. So I think a lot of dentists are really busy this time of year.
Yeah.
The other thing, and this is really great for self-employed individuals, it would be a health savings account. So a health savings account is a vehicle to put money aside for medical expenses. You get a tax break on your tax return, and then you can use those funds tax-free to pay medical expenses.
So on one of those, though, on the health savings account, I know I had one for a while, and I ended up dumping it because what I was told is that I can only use it for actual like doctor or hospital visits. They took away medication and supplements. Like I could no longer use it to buy vitamins or off-the-shelf medicine. Is that accurate?
You know, it really depends on the plan as well. However, I know prescriptions for sure, and I do have heard rumors that some of the alternative medications are allowed starting in 2018.
Oh, okay. Well, then it might be worth revisiting because, yeah. I mean, you know, I fortunately, knock on wood, have been healthy enough to avoid the hospital too much. But, you know, like to get my supplements and, you know, over-the-counter medications. And it seemed like that got limited. Now I'm talking a few years ago, so things might be different.
Yeah, and as far as I know, you can use it for co-pays, for mental health, if you're going to see a counselor, if you are seeing chiropractor, and so on. Acupuncturist, I've heard, is also included at this point. So I think they've expanded the category quite a bit. I do know you cannot use it for premiums. So you can't use it to pay for your insurance.
Okay, that makes sense.
I know that's limited. Yeah.
All right, well, that's good. That's good to know. You taught me something already. I might go revisit that. And let's talk about that for a second. Though, like, why would somebody want to do a health savings account? Isn't it a way to defer taxes on that money you put in there?
So you're not necessarily deferring taxes. It's a tax-free way to pay for medical expenses. So what you do is up to the limit, you can put about $6,000 away for a family. And you can make withdrawals out of the account. You take the tax deduction on your tax return. Some employers offer it, so they run it through your W-2. That money is then not taxed. And then when you pull it out and use it for qualified medical expenses, it is tax-free money to pay. So I think it's a really great way. You do have to have a high deductible plan though. So do be sure that your plan qualifies, because not all plans qualify. Oh,
okay. Gotcha. All right. Good advice. All right. Let's move on to some disappearing deductions. One that I'm going to start dealing with as one of my specialties is working with divorcing homeowners. Alimony deductions are no longer tax deductible, correct?
So in the past, this is actually really huge, and it's going to hurt a lot of people, unfortunately. So in the past, if you were paying alimony, you were able to deduct that on your taxes. Mm-hmm. And then whoever you were paying it to, that was considered income for them. So starting with new agreements as of 2019, if you're a payer of alimony, you no longer will be deducting that. And so the way that we're seeing it is that this is really going to affect the way that alimony agreements are negotiated. You'll be willing to pay less, obviously, because you're the one who's bearing the burden of the taxes. Mm-hmm. So the recipient is going to ultimately suffer also, because then they'll be receiving less as well, which is.
Yeah. So, I mean, in theory, if somebody's lawyer can swing it that way, they're going to do the calculation of what the alimony is determined to be minus what the tax deduction would have been, and there's the new principal, if you will, going to the recipient.
Exactly. Okay. What you need to keep in mind, though, and you definitely have to check depending on what state you're in, but California does not conform with this. And what that means is, for California, it's business as usual. If you pay alimony, you get the write-off, and if you receive it, you report it as income. So definitely something to keep in mind. For federal purposes, it's one way. California, it's the other.
Okay, so this is for the other 49 states, but not California.
I don't know what the other 49 states say at this point, but California for sure is not conforming.
Okay, so alimony is business as usual in California.
That's right.
Okay. What about other things that are going away, like casualty and loss deductions?
Yeah, if you have a flood in your home, unless you're in a presidentially declared disaster area, unfortunately you can no longer write that off. One of the other things that's going away is if you move. In the past, you were able to write off your moving expenses. So for federal purposes, you no longer can write off your moving expenses. Yeah.
Okay, and then as someone that has a W-2 employee attached to him, miscellaneous itemized deductions are going away. I mean, in plain English, somebody that is employed but has out-of-pocket expenses associated with that job, maybe travel expenses or fuel.
Sales.
Yeah, normally they were deducting those as an expense of doing business.
Yes.
But as a W-2 employee, those are gone.
Correct. And so what we're advising clients is talk with your employer, be sure that, and potentially they have an accountable plan in place, the employer that can then reimburse and write those expenses off. Then you no longer bear the burden. You no longer have to report. Again, for California, it does not conform. So business as usual for California. So you still can write those off for California purposes, but not for federal purposes. Yeah, so it's a little confusing. Another thing that may affect people is that the standard deduction has just about doubled. So there will be a lot of people who are no longer itemizing, given that the state and local income tax deduction has been dramatically cut and miscellaneous itemized deductions have been dramatically cut. And the standard deduction for married couples now is $24,000 versus $12,700, which it was in the past. Head of household is up to $18,000. So we're seeing huge standard deductions at this point. So it may even be that a lot of people are no longer itemizing their deductions at all.
So, I mean, just again, to put it in layman's terms, so you would basically have your tax preparer do the calculations, and if it makes more sense to not itemize because you're going to actually do better with deductions that way, and that simplifies it for the individual then.
Yes, yes, absolutely, except for California, because for California, the rules are different.
All right, okay. So,
complicated. They tried to simplify, and fortunately, they made it even more complex.
Of course.
We now have a 1040 postcard with 6 new schedules.
Okay. Well, I'm glad that's your job and not mine.
A lot of fun.
Is anything remaining the same that people are confused on? They thought it changed, but
yeah, absolutely. Yeah, there was a lot of talk about Section 121 going away. So what Section 121 is so if you own your home and you lived in it for 2 out of 5 years,
right,
you could sell your home and you could exclude capital gain income up to $250,000 per spouse or per joint tenant. So they were saying they were going to cut that. Fortunately, they did not. So you still can live in your home for 2 years, sell it, and you can exclude the gains on that. So that did stay the same.
Okay.
One of the other things are for teachers. There is an educator. The educator expense is $250, a deduction. It's not huge, but they were going to cut it, and they did leave that in there. The other things that they did leave, thankfully, are the solar credit. So
okay.
You still can install solar on your home. It's a full 30% credit on the purchase price and installation of the solar. Wow. So, it is still 30% for 2019. In 2020, it goes down. So it is time, if you really want to take advantage of that full 30% credit, you may want to move on that this year. And the nice thing about this credit is it is non-refundable. However, so non-refundable basically means if you have zero tax liability, you cannot take the credit. So let's say your tax liability is $2,000, but your credit's $10,000. The remaining $8,000 credit will roll over to the following year. So it is a carryover credit. Whereas the electric vehicle credit, which is also still in place, so if you bought a Tesla, a Chevy Volt, one of the other electric cars, there is also a $7,500 credit available, which does not carry over. So if you did buy one of those vehicles in 2018 and you think that your tax liability is going to be less than $7,500, you may consider seeing if you have money in your IRA and doing a Roth conversion this year to absorb some of that credit.
Oh, okay. So there's little strategies.
Exactly. Yeah. And the other things that they left in there, thankfully, are for college students.
Yes.
The American Opportunity Credit is still available. It's a refundable and non-refundable credit up to $2,500. And then the tuition and fees deduction, I believe they also still left and is available.
Okay, so the student loan interest and the related expenses around tuition, there's some deductions.
Yes, absolutely. So good news for students.
Yeah, and for parents like you and I.
Yes.
Okay, so I know you mentioned when we were talking off screen about new business deductions. Do you want to talk about those a little, since we have a lot of business owners listening?
Yeah, absolutely. Thanks, Thomas. So a lot of my clients and people have been asking, okay, so am I a winner or am I a loser with this tax bill? So who are the winners and losers? And so business owners absolutely are coming out ahead with this. And so one of the big questions that I've been getting from clients is, well, do I need to incorporate? Do I need to form an LLC? Do I need some sort of entity for my business in order to take advantage of the new tax write-offs? So, and the answer to that is no. You can operate as a sole proprietor, continue to file as a Schedule C. It's no problem. You still will qualify for the new big deduction, which is called the Qualified Business Income Deduction, or what they're calling the 199A or QBI deduction. And what it is in its simplest form is it's 20% of net income from the business. You get to take 20% of that, and it appears as a deduction on your 1040. So it's very complex, and you definitely want to talk with a tax advisor to see if you qualify and how you would qualify and how much you would qualify, especially if your income is over limits of, if you're single, 157,500, or if you're married, 315.
Okay.
So those are some limitations. If you're up there, you definitely want to talk with an advisor before the end of the year, figure out ways to get your taxable income down, because it does phase out for certain businesses at certain points.
So it seems like now more than ever, you've got job security, because this is getting more complicated.
Yes, they keep saying every year they're going to simplify it, but they keep making it more complex.
Seriously, yeah. I mean, I couldn't even imagine at this point running my business and trying to do my own taxes. I mean, it's the time alone it takes, but on top of that, just knowing all this and not leaving money on the table, or worse, creating a penalty for myself.
Yeah, and you're absolutely right. For accountants, it's definitely the Full Employment Act for us. They've just made it so complicated that we're just feeling like we're scrambling just to learn the new law before the new year. We don't have the new forms yet. We have some drafts for the forms, but really meeting with your advisor between now and the end of the year, deferring income, bringing your taxable income down through using 401ks, using solo 401ks if you have a business. SEP IRAs are great. IRAs, Roth IRAs won't bring your income down, but it's a way to save money tax-free. So definitely look into all of those options before the end of the year. There's a lot of new expensing rules. So in the past, as a business owner, you could take depreciation or bonus depreciation, but you couldn't take it on used equipment. It was only had to be new. So starting in 2018, you can buy a used car and qualify for bonus depreciation. So this is huge, and they've really bumped up the limits for equipment and for leasehold improvements, qualified leasehold improvements. So there are really ways to bring down your income this year. And so business owners, I will say, probably the biggest winners across the board with this new tax law.
Well, that's good news for us. And I know that there's, excuse me, a difference in some cases between a service business and a non-service business. And non-service meaning something like an architectural firm or an engineering business, so forth. Are they seeing any differences across the fence than are service-oriented like you and I?
Yeah, yes. So that's a great question, because there was a lot of confusion, let's just say, about this new qualified business income deduction, that service-based businesses did not qualify for the deduction, and that's not true. So, okay. If you are a service-based business, meaning you're an accountant, or actually realtors are not service-based businesses. They're specifically excluded.
Really?
Which is interesting. But law practices, accountants, manufacturing is a non-service-based business. So you really have to talk to your advisor to find out which category you fall into. So service-based businesses really have to watch out. They're the ones who have to look at that phase out that I just mentioned, because that's where they will lose the deduction completely, versus the non-service-based businesses, which can make over, if you're married, $415K and still qualify for the deduction. But there are some additional, basically you go down another path where you look at wages and you look at your equipment and look at those. So there's definitely some planning that needs to go on if you are a non-service-based business, manufacturing, or so on. You're selling product.
I guess there's enough bad realtors out there. They decided we weren't service based. We'll try to get that changed. So
I don't think that's what it was calculated on. I think they were looking at the fact that you were selling a home. And
yeah.
You're selling something.
Right.
Therefore, it wasn't necessarily a service. Rather, you were selling a product.
Okay. All right. Fair enough.
The biggest asset that someone could buy in their lifetime. So
true.
Yes.
True. Well, let's talk about just how this plays out in real life. I mean, you were talking about who wins and who loses.
Besides business owners, I will say that families with children will definitely come out ahead on this one.
Okay.
One of the things we haven't mentioned yet is that personal exemptions have been eliminated. So in the past, families were able to take a personal exemption and dependency exemption for their children or elderly parents or a qualifying relative that lived with them, up to $4,000 approximately per person who lived in the household. So those have all been eliminated starting in 2018 through 25. But
Wow.
right, I know it's kind of huge. The good news though is that two things. Number one, the tax rates have been reduced. So your total income will be taxed at lower rates across the board. Number two, they have created something called the Enhanced Child Tax Credit, which is a credit which is now $2,000 per child until they turn age 17. And in the past, a lot of families were not able to take this as a credit on their tax return because once your income hit 110, that was phased out. And so that was huge. And for a lot of Californians, this will mean a lot less in tax that you're paying because per child, you'll be able to qualify for this $2,000 credit per child if your income is under $400,000.
Oh, okay. So it comes out in the wash, but I mean, initially, I mean, that was kind of rough to hear that they took away the $4,000 deduction, but it seems like they made up for it.
They're trying. It kind of feels like they moved all the chairs around in the room.
Yeah.
And it may come out approximately the same. I do think that a lot of families will see some tax savings. One of the things that we are a little bit concerned about is that as advisors, we're seeing the federal withholding on paychecks is not necessarily enough. So I've been telling my clients throughout the last 3 months, keep your eye on your withholding, take your last pay stub, look at that federal withholding, divide it by your gross taxable wages, and hopefully you're over 15% withholding. Hopefully you're closer to 20% in federal withholding. And for California, 6, if you take your California withholding on your pay stub divided by gross taxable wages, you should be right around 6-7% in order to come in ahead.
I want to kind of jump back to a question that popped into my head when we were talking earlier when you mentioned people assuming they needed to form a corporation. But is there a point, and is it an annual income point or some other point where a small business owner or an entrepreneur like myself or a lot of our listeners should actually consider forming an S Corp?
That's a great question, Thomas. I have clients ask me that all the time. So what I tell them is an S corporation absolutely will save you taxes. However, there are costs associated with it. So if consistently your net profit is between 70,000 and 80,000, I would say that's probably the time that you should start considering it.
Okay, but to repeat, net profit, not gross.
Correct. So after expenses, after expenses for home office, for your auto expense, advertising, etc. Once you hit that 70,000, I think that that's really when you want to start. Maybe 2 years in a row, feel like the trend is upwards, because if you are in California, number one, you're going to be paying for the franchise fee, which is $800 minimum annually.
Okay.
Then you're going to be paying for a second tax return. If you form an S corporation, you have to pay yourself a salary, so you're paying for a payroll service. So there are these additional costs. However, there are tax savings. So once you hit a certain dollar amount, I think it makes sense. Okay.
Good to know, because that comes up a lot in my circles too. People talking about forming corporations, and yeah. I know a lot of real estate investors form LLCs around their properties.
Correct.
But that's different than having an S corp or a C corp. And any thoughts on the difference? You know, how does somebody decide whether it's an S corp or a C corp they need?
Your goals, honestly. Okay. So with an S corporation, it is a flow-through entity, which means in essence, the corporation itself on a federal level does not pay tax. The profits from said corporation flow to personal tax returns of the shareholders. With a C corporation, it's like its own little island, and the corporation pays the taxes, and in order to get the money out of the C corp, you have to pay yourself a salary or you can take dividends from the corporation. So with the new tax code, that received a lot of press for C corps, that, you know, the tax rate for corporations is now 21%, which is great for big corporations that make a ton of money. It's not great for some of the smaller C corporations that in the past that they kept their profit below $50,000 and were being taxed at 15%. So now, instead of it being a graduated rate, it's 21% across the board. So what I'm going to be seeing, unfortunately, with a lot of my smaller C corporations is they're going to be paying more tax this year unless they, bonus all that out through W-2.
Gotcha.
So just because you're a C corporation doesn't mean that it's better tax-wise. There are definitely advantages for C corporations, fringe benefits, you can deduct medical expenses. So you really want to look at what your goals are before you choose between the two.
Okay, yeah, definitely new strategies involved too.
Yeah, if you're looking for outside investment, absolutely, C corporation's probably the way to go.
Okay. All right, so we've got about 2 weeks left in 2018. What are some steps people should be thinking about taking in the next 2 weeks before they run out of year?
Well, definitely, I would say look into maxing out your 401k if you haven't done that already. I mean, there's definitely a lot of debate. Should we defer the tax or do we pay the tax now? I'm a huge advocate for the Roth IRA. You still have time to fund a Roth IRA until April 15th. So you still have a little bit more time on that. But if you're a business owner, you may consider a solo 401k. All of that has to be in place before the end of the year. So you want to talk to your financial advisor now rather than later. Probably things to be thinking about also are donations. If you have a pile in your garage, get rid of it. Take it down to the Community Resource Center, Salvation Army, whatever your favorite charity is, and do those non-cash donations. Keep the slips because they do count and they're not affected by the new tax code. Other things to consider are if you have capital gain income for the year, definitely look at your portfolio to see if you have any losses. So you could sell off the losing investments to offset any gains, call it tax harvesting. Other strategies to consider would be, meet with your tax advisor and really talk about, in light of the new tax law, bunching your deductions for, every other year, so that one year maybe you're itemizing, maybe the next year you're not itemizing. So that might be a strategy to consider, because in the past, a lot of people have been prepaying property taxes, which at this point doesn't make any difference at all because you're capped at $10,000. So that's not a strategy. If you're prepaying your estimates, which people were doing in the past, that's no longer also an option. So you definitely have different strategies with the new tax law. Some of the things that I've been chatting with clients about is if you are over 70 and a half and you are required to take a minimum distribution from an IRA, you can, instead of taking it as a distribution to yourself, you can actually take that as a distribution directly to a charity if you like to give to charities. That way it's not included in your income. So therefore bringing your taxable income down, and if you're receiving Social Security, potentially you're paying less on your Social Security benefits. So it's a win-win, well, win-win-win. So you're giving to charity and you're taking your required minimum distribution and you're paying less in tax overall. So that's a little strategy there that has been working for some of my senior clients.
Okay. So, just a question that popped into my head there about Social Security. Where do you fall on the fence with people taking it and using it as soon as they have it available versus letting it stockpile and not using it right away? Because I've heard strategies for both.
There are arguments for both sides of that.
Yeah.
But I've done calculations for clients, and honestly, it really makes sense to take it before you need it. It just, unless you're planning on living to be 105, it may make sense for you to take it early.
Okay. And then an industry question. What comes up all the time in real estate is, should I own my car or lease my car? What makes more sense? From a tax point of view, where do you fall on that?
It's a personal decision.
So there's no real significant difference?
So if you like to have a brand new car every other year and you want to be styling, and lease might be a way to go, there are limits on it, but it really, really is a personal decision, because from a tax perspective, you can write off your lease payment.
Right.
If you buy the car, you get depreciation. You get
right.
So it really, in my mind, is, do you want to rent your car or do you want to own your car? And so it's your decision.
Okay, fair enough. Is there a question I haven't asked you that I should have, that we should discuss?
Oh gosh, Thomas, there's so much to talk about with the tax code. But I think we've really talked about a lot of it. My biggest piece of advice for people is really just to talk with your tax advisor. Make sure that you are doing your planning. If you're a business owner, start the year off right with the budget and really be looking at your financial statements every month. I just think that as business owners, we get bogged down with the day-to-day, and we don't take enough time to really set our goals and to take time to think about our businesses like we should. So that's my piece of advice is really for the new year. Start out with a budget, with goals, and go get after it.
You know, and I might be putting you on the spot here, but if somebody wants to get more familiar with creating a budget or setting goals like that, I mean, do you do any reading that you would recommend to someone, a book or course or anything in particular you could recommend to people wanting to get more information?
Well, we actually teach a budgeting course, and I do a lot of one-on-ones. We're moving our practice in the direction of business management. So definitely if business owners want more information on that, have them contact us directly.
Okay, well, what's the best way to get in touch with you?
They can reach out to us via email. I'm Rachel at elmtax.com, or you can call our office at 760-730-1817.
Wonderful. And their website, folks, is www.elmtax.com. So it's Easy Life Management, but both the email address and the website is elmtax.com. All right, Rachel, thank you so much for blessing our show with your information once again. You always keep us up to date on what's going on. It's very confusing for us. As you know, we're busy entrepreneurs, so it's good to have a professional. And folks, I'm just going to give you another testimonial for Rachel and her staff at Easy Life Management. She's been preparing my taxes for many years now and literally changed my financial future with the understanding and all she's taught me over the years. So I highly recommend her. Reach out to her and her staff. They'll take good care of you. And like I said at the beginning of the show, doesn't matter where you live in the world. She is international.
That's right. Thank you so much, Thomas.
It was a pleasure. And Merry Christmas to you and Happy New Year.
Merry Christmas. It was an honor. Thank you.
All right. Thank you. Bye-bye.
Bye.